Hi, welcome to MC The Accountant Shares. For this afternoon or day, I'm going to discuss to you and share to you guys about IFRS 15. This is the standard, the new revenue standard for financial accounting and reporting. And the title is Revenue from Contracts with Customers. So this is a response to the comment said that I should also be going into other subjects in the accountancy curriculum. Yes, that is true. Otherwise, we will be leaving the other subjects also. So we want to cater different markets. So watch out, guys, because in a week, I'm going to make sure that I can touch, for example, basic accounting, partnership and corporation accounting, auditing, and so on and so forth. And so what I would like you to do, guys, is that for the meantime, please bear with me. For example, as you research for some information about the standards. So I would like you to look into the first part here of the standard. So kindly read for a while from the title and so in the overview of the standard, this particular standard actually supersedes the previously issued revenue accounting standards and reporting standards. So the word is supersede. In other words, it will overlap, it will make the other revenue standards ineffective. So example, we have IAS 18 revenue. IAS, by the way, stands for International Accounting Standard. This is based in UK or United Kingdom in London, and this is made by the International Accounting Standards Board. So more of the discussions of that will be there in other sessions as to what is IASB and the others. Now, we have started already with IAS 18 revenue. This was the previously prevailing or applicable revenue accounting standard. But then it is to be superseded by IFRS 15. Also, there were some accounting standards that were also applicable, like IAS 11 construction contracts for a while. Oh my, I don't know, whenever I record, there are some interruptions. In fact, you can hear some noises, so please disregard. Anyhow, this is how it goes in live settings. There could be some interruptions. So hopefully you will forgive me, guys, for this. Anyway, so again, there are some accounting standards that would be superseded. So you have here IAS 11, construction contracts. Then you also have the IFRIC. IFRIC standards stand for, or IFRIC means International Financial Reporting Interpretations Committee. So this will be discussed under conceptual framework and under also IAS 1, the very first accounting standard, that there are 3 sets of accounting standards that are contained in IFRS or International Financial Reporting Standards. These are International Accounting Standards, International Financial Reporting Standards, and IFRIC, International Financial Reporting Interpretations Committee Standards. Now, these 3 sets of standards are having the same level. It does not mean that IFRIC, which is an interpretation or which are interpretations of the accounting standards, which will explain further certain concerns about certain parts of the standards or such as supplementary materials of the other accounting standards. It doesn't mean that it is, or this particular set of standards is of lesser authority. It has the same authority as of the other two, like the IASs again, IFRSs, and the IFRIC standards. All right, I hope that is clear. So in other words, these 1, 2, 3, 4, 5, 6 standards are now not applicable. This is starting 1st of January 2017, internationally speaking. But then, because we are in the Philippines, so we apply this probably later. But then there's like a ruling that whenever is the applicability of an accounting standard, we have to consider like 6 months. And then after that, such would be included already in the board examination or licensure examination for certified public accountants. So probably we had the application or effectivity date after 1st of January 2017. Okay, so all revenue contracts will be governed by IFRS 15. So IFRS 15 will improve comparability of reported revenue over a range of industries, companies, and geographical areas globally. Okay, so objective, scope, and effectivity date. So IFRS 15 will improve comparability of reported revenue over a range of industries, companies, and geographical areas globally. So the reason that we have this standard is for us to be able to have uniform standards that would be applicable to all contracts involving revenue. So basically we talk about sales and service income, sales for goods, and then service income for services. And if we have the same set of standards that would be applicable to such, this means that we can achieve comparability more because we are going to apply the same set of accounting standards. Next is objective. So the point of this is for the entity to report useful information to users of financial statements. So like what we have discussed in IAS 1, or perhaps not yet as of the moment, the purpose of any accounting standard is for us to improve the quality of information that we provide to the users. So it can be affecting, for example, in this particular accounting standard, the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with the customer. Because if we have some contracts in the customer, ultimately, we will talk about the amount of the revenue and when do we recognize the revenue, as well as when do we recognize the collection, or what would be the entries that would be made should we collect the said amounts coming from the contract. And then you have here also the scope. So can you read for a while? So you have here the objective as explained. You also have the scope. So also forgive me guys for the sounds in my background. For the scope, meaning the particular accounting standard, which types of transactions that such is applicable. So this particular standard applies to all contracts with customers. So any transaction, any sale transaction for this matter, in which there is buyer and seller, or there are the parties involved, the buyer and the seller, such accounting standard, the new revenue model would be applied. However, the exceptions would be these following types of contracts. What is the reason? It is simply because there are applicable standards for such. For example, for leases, we already have the new revenue standard for such, or the new accounting standard for such, in which that is IFRS 16 for leases. For insurance contracts, we had IFRS 4 before, that was phase 1, but then it was improved further on to have the phase 2. And that is why IFRS 4 is no longer or longer applicable to insurance contracts. And that's why the applicable one is IFRS 17 for insurance contracts. For financial instruments, we have two accounting standards. We have PFRS 9 for financial instruments recognition and measurement, and we have IAS 32 for presentation and disclosure. among other types of contracts. So in other words, this particular accounting standard would be applicable except if there is any specific accounting standard that is applicable for such. In fact, the sale of non-monetary financial assets such as PPE, real estate, or intangible assets will be governed by this one. What's the reason? Why is it that these types of sales would still be utilizing or using IFRS 15? The reason is that this is sale. So any sale contract, the IFRS 15 would be applicable. And then we have here also, what if a contract is, let's say, containing a lot of provisions, and then certain portions or scope of it or part of it or parts, could be plural, we can apply IFRS 15, but in some parts, we are going to apply another standard. So in this case, the first situation is that if we can segregate the parts or components, so those parts in which IFRS 15 is applicable, then we are going to make use of this new revenue recognition model. But for the other part, then we have to apply the specific standard. So the transaction price then is reduced by the amounts that are initially measured under other standards. And the second one is, if other standards do not provide guidance on how to separate and or initially measure one or more parts of the contract, then we are going to apply or make use all of the standards, which means we are going to apply IFRS 15. I hope that is clear. Then effective date, as what I've mentioned, we are going to apply it on or after 1st of January 2017. However, which is the usual case or situation that perhaps the application date would be later. So normally the international counterparts in which we base our accounting standards would be applying such first before us. And then it's also possible for some entities or standard setters to allow, for example, for early adoption of accounting standards. In that case, that is allowed, that is encouraged, but it's not yet required. So for example, let's say the Philippine standard setter, which is FRSC, the Financial Reporting Standards Council, would be requiring us to make use of this standard starting January 1, 2018. So for the year 2017, Philippine companies may apply this accounting standard. That's why, as what I've said, early adoption is allowed. Next, you have here the different terms to be used under the standard. So please take note of these terms because they are very important for the accounting standards. So you have here the contract, customer, income, performance obligation, revenue, and transaction price. So for the contract, this means this is the agreement between two or more parties that creates enforceable rights and obligations. So you have the two parties, the buyer and the seller normally. So we are on the part of the seller because it is the seller that recognizes the revenue. The customer, on the other hand, is the one that purchases the products, either goods or services. So the customer basically is the buyer. Income, this is one of the accounting elements, which means simply means increases in economic benefits. In the introduction to accounting, I already explained that when we say benefits in accounting, it does not only mean financial, it can also be quantitative, could be any numbers except money, could also be qualitative. So meaning to say it can be in form of words. And it is in the form of inflows or enhancements of assets or decreases of liabilities. So if you can recall, equity has a direct relationship with assets and vice versa. So in other words, if equity in the representation of income would increase, assets also would increase. Or if assets are enhanced, would increase, so equity or income would also increase. And this is inverse with liability because liability and equity have inverse relationship. Okay, so it will result in an increase in equity other than those relating to contributions from equity participants. So these are the investments or the investments of the owners. All right, this one is very important, the performance obligation. A performance obligation is the promise in a contract. We call this sometimes PO when you hear this in discussions. So a promise in a contract with the customer to transfer to the customer either it's possible that the customer would be ordering our products offered, which can be in one, good or service, or combinations of goods or services. And any combinations could be one good, one service, or two or more of them in one set. And they are distinct. So meaning we can identify such from each other. Or letter B, what if it's a series of distinct goods or services? So they are substantially the same and that have the same pattern of transfer to the customer. An example of this one is, let's say, a construction contract wherein it's going to be many projects in one contract, not just one building. So let's say you are going to develop an area and you are going to construct 5 buildings. So in that case, we are going to consider series of distinct goods or services because they are going to be finished perhaps in different time frames. So of course, it's going to be dependent upon the terms in the contract. But I'm just saying in that example. So the revenue, the income can be divided into two. You have income, which is arising from the ordinary course of activity. So meaning the main line of business. Let's say the business is a trading concern, meaning let's say a retailer. So whatever income that it earns by selling the products, that's going to be revenue. And then the other one is gain, which is not discussed here because mainly revenue from contracts with customers talks about revenue, which is coming from the main line of activities of the business. But it doesn't mean that we are not going to apply the same or this particular standard for gains. Remember, this is our revenue recognition standard that supersedes the other revenue standards. All right, so you have here the revenue model. So you have here the different or various steps, and you have the steps in which we are going to recall. So this is the illustration, and there's also another one I want you to see with this one. So this is our new 5-step model, and for a while, so you have step 1, identify the contracts with the customer. Step 2 is on the obligations. So we need to know our POs, performance obligations. Step 3 is we need to know the price. Then if there are multiple performance obligations, so we have to allocate the price to those contract obligations. And we are going to recognize the revenue. So these are the 5 steps. When I teach to students, I normally require them to really memorize. Why is that? They said that accounting is not on memorization. Yes, that is true. However, there are some parts that we really have to recall. Otherwise, we will get or we will be lost in transition in application of the accounting standards. Hopefully, you are still with me. Then you have here the steps. So please take charge. Let's begin with step 1, in which we are going to identify the contracts with the customer. So the contract again is the agreement between one entity and another entity. So in this case, the buyer and the seller. And I repeat, you're on the part of the seller. So these are the criteria that should be met in order for a contract with a customer to be applicable. So you have here, the parties have approved the contract, of course. Then we can identify each party's rights. If you are the buyer, if one is the seller, we need to be able to know their rights. So normally the seller has the right to receive the consideration or fair value of the assets transferred or delivered to the buyer, and the buyer has the right to receive the goods promised in the contract. Then the third one is we can identify the payment terms and conditions. Is it cash? Is it on account? Is it with a promissory note? Is it short-term note or long-term? So in that case, we are going to compute for the present value if it is going to be a long-term note and it is non-interest bearing. All right. So the contract has commercial substance. Now, what do we mean when we say that the contract has commercial substance or the commercial substance phrase? It means that the values on two parties would have differences with each other so that one party will be paying the value of the difference. So in this case, this just means, for example, commercial, which is coming from the word commerce, which means buying and selling. Because when you buy goods or sell goods, for sure, there would be values to be received. And the collection is probable. So when we say probable, the possibility that something will happen is greater than the possibility that it will not happen. So that actually is the meaning of probable or probability. So let's say in accounting, by the way, accounting perspective, because we also have probability in mathematics or other disciplines. Now, if we say 51% possibility or chance or likelihood that it will happen, 49% that it is not, therefore it is probable. Okay, so we should know that. Then if all of the criteria are met, then a contract shall not be reassessed. Why is that? Since it's clear already, crystal clear about the parts of the contract. However, if, for example, it does not meet all of the criteria, because we said that a contract will fall under IFRS 15 if all these criteria are met, then we are going to reassess because it's possible that in the latter term or part of the contract, it is going to satisfy or qualify all the 5 requirements set under step 1. Next, if we are going to analyze everyone, it should be on an individual contract basis. Why? Since every contract is unique from the other. So even if it's going to be a same like sale contract, there can be differences. Now, if for example, let's say you have plenty of contracts, let's say thousands, hundreds, or millions of them that are still existing when we are required to apply IFRS 15, meaning we have to revise the terms of the contract. We need to make retroactive adjustments because they are still applicable. Let's say it's going to really having the latter terms in which they are for longer periods of time. So we need really to make retroactive adjustments. We have to go back in time. So if let's say it's going to be many, there is the so-called portfolio approach, which is only allowed for that situation. This is a practical expedient. If we say practical expedient, it means that we want to make our work faster. So we want to expedite the process. In other words, we need to make it fast and it's practical. So the application is because of certain reasons that probably, for example, it's going to be very costly on the part of the company to apply individual contract basis for contracts that have already existed for so many years. So that's why we can apply portfolio approach, but this is permitted with contracts having similar characteristics. So if we have clearly different characteristics, sorry, we don't have any choice but to apply individual contract basis. Okay, hope that is clear. Another one is contract modification. So it's possible that if the contract is long-term, or even short term, like months after, there would be some changes, some updates in the contract. And we have to know if certain conditions really are met. So we need to account it as a separate contract. So in other words, the standard here clearly says shall, meaning it's a requirement. If we satisfy the two requirements, so in other words, if there is contract modification, it's going to be applied similarly or together with the original contract. It's not going to be a separate contract. However, if, for example, it is able to satisfy the two requirements, therefore we are going to apply it or consider it as a separate revenue contract. So there is an addition of promised goods or services that are distinct, which is really a requirement in this particular revenue standard, that the goods are distinct from each other as well as the services. And then it increases the scope of the contract. So there is an addition of a good or a service because it is modification. When you say modification, change, variation in the contract. And then because of the addition of the good or service or more, or both, or many of them, so the value of consideration or the transaction price is becoming big, or it increases also. All right. So meaning the selling price of the contract increases because of the addition of the promised good or service. And if the above conditions are not met, so a contract modification will be accounted for prospectively, meaning if you say prospectively, so from this point in time onwards, so present and future, or retrospectively, meaning to say if the remaining goods or services to be delivered after the modification are distinct from those delivered prior to the modification, by modifying the accounting for the current contract with the customer. So what is clear here is that if it's able to satisfy the two, so it's going to be applied retrospectively. But if not met, so there is a choice to apply prospectively or retrospectively. All right. So that's for step one. Next, step two, we identify the performance obligations in the contract. So at contract inception, an entity shall assess the goods or services that have been promised to the customer and shall identify as a performance obligation. Okay, so we have a good or a service that is distinct, and again, series of distinct goods or services. When can we say that a good or service is distinct? So this is when the following criteria are met. If, for example, by the way, it's are met, so meaning that two must be satisfied. The customer can benefit from the good or service on its own or together with other readily available resources. And the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. So I think that explains, number one, is that this particular good can benefit me separately from the other service or good, for example. And I need to transfer it separately from the others, unless it's going to be in a bundle or together. On the other hand, because this part here is possible, a bundle of goods or services. Then the second one is that a series of distinct goods or services has the same pattern of transfer to the customer if the following criteria are met. So for the two requirements here that should be met, or criteria that should be met, it must be that also the distinct goods or services are there and they are just done in series. So at different stages or different points in time, we are going to deliver the goods or services or provide or render the services. Now, also, the same method of measuring progress would be used. So what percent of the contract in which we have already satisfied or complied with. This is on the second one. Then, what are the factors to consider to transfer the good or service? So we have if the service is significant, so it's a significant service of integrating the good or service with other goods or services promised in the contract. So this means that a good or service is distinct if there is integration or if there is one, it does not provide significant service as to the other goods or services. So meaning there might be a link or connection or relationship, but it's not significant enough to warrant or for us to say that the two goods are of the same or they have to be considered as one, not distinct. Then if one good or service does not modify or customize significantly the other good or service. Take note of the word significant for the first two. So what is significant? Another word is material. It's going to be a case-to-case basis. So it does not mean that there is integration for one, there is modification or customization, that it's going to be automatic that the two or more goods are now of the same, meaning to be lumped together. Okay, then the good or service is not highly dependent. By the way, when I say lumped together, I'm not talking about bundle. Bundle is a different thing. In a bundle, the goods or services are distinct, are different from each other. However, they are still of different distinct goods just in one pack. But for these three situations, if they happen to be significant, then we can say that two or more goods are just one. So we will count them as one good or service. I hope that is clear. And then if good or service is not highly dependent on or highly interrelated with other goods or services promised in the contract. All right. So not also significant or material in terms of dependence and interrelation. Okay. So in this particular example, we have here an adaptation from IFRS 15. By the way, we are just going to end at this particular step 2, and then we are going to have a part 2 of this one, which will be steps 3 to 5. So for this particular part here, we have an entity, a software developer enters into a contract with a customer to transfer the following. So you have the following 4 goods and services to be delivered, but I think this is more on a service because it's about software developer and development and the sale of a license. So license is service. It's not, for example, really a good because good is tangible. So you have the software license, installation service includes changing the web screen for each user, software updates and technical support for 2 years. There's additional part. The entity sells the above separately. The installation service is routinely performed by other entities and does not significantly modify the software. By this particular statement alone, by the way, the first statement sells the above separately. We might have a clue that they are distinct, but we need to read more. In the second one, the service is related to the license. However, it does not significantly modify the software, which also means that even the user can install the license, not necessarily that the developer will do it for the buyer or the customer. Then the software remains functional without the updates and technical support. So by that alone, clearly I would say they are 4 distinct and separate services here. So are the goods or services promised or to be performed to the customer distinct in terms of IFRS 15? So in this case, we are going to consider them as distinct goods and services. The entity concludes that the customer can benefit from each of the goods and services on their own or together with the other goods and services that are readily available. So clearly the promise to transfer to each is separately identifiable from each other. Even if the installation service is closely related to the license, but the former does not significantly modify the software. Remember here, the exceptions to the rule or the situations in which we can still consider them as distinct if there is no significant service, modification, customization, or highly dependence or interrelationship. All right. So the last part talks about what I've explained a while ago, that the service is not significantly modifying the license. All right, so that ends the first part of IFRS 15. Hopefully you learned something for this session, guys, and I'll see you next time for the part 2 of this particular standard. Don't forget to subscribe to my channel, like this video, and put your comments or suggestions or interactions or reactions for this one, and I'll see you next time. Bye for now.